All right, it's been a few days since I've done a video. So for the weekend here, I think I'll just take a quick look at the stock market and the metals market. um, we knew that the plunge protection team was going to come in, try and prop up the market ahead of the Jackson Hole meeting. They pretty much do this in front of every Fed event, whether it be Jackson Hole, Humphrey Hawkins address, an FOMC meeting. Doesn't matter. That's been the pattern for years now. It just makes the Fed's job much easier. If the market is moving up, at the all-time highs or at least in an uptrend ahead of these events. So we knew that they were going to uh, intervene in the market and turn it back up, and that's exactly what they did. You can see we had these two reversal candles. These were clearly they were painted. This was painted on Friday afternoon last week to make sure that this weekly candle wasn't bearish, and that set up the market to drift higher into the FOMC or into the Jackson Hole event. I notified my subscribers uh, Friday before the market opened that at that point they needed to make a decision whether or not they wanted to continue to hold long positions, seeing as how really the only um, reason for taking a long trade was just under the assumption that the government would prop the market up ahead of that event. Once the event was over, then there's risk that the selling pressure would resume, uh, or the protection for the market would be withdrawn, and back down it would go. So I suspect most everybody uh, either just took profits or a break-even trade right at the open on Friday, and then that's exactly what happened. The market, with a little help from China and President Trump, uh, moved back down. But this was had already started long before the new tariffs came out or any tweets from President Trump. This started back here. Um, right now, the government is trying to fight the natural trend, but the trend is down, and we've got an intermediate cycle that appears to be left translating, which, as I've said before, opens the possibility of not only breaking below this intermediate cycle low here, this May low. There's a possibility that during a final bloodbath phase, and I think that's going to be pushed out into October. I've gone over that in the weekend report if you want to see the detailed analysis of how I come up with October as being a likely spot for a final intermediate cycle low. You can go to the weekend report for the premium subscribers. But anyway, if this breaks, there's a possibility that we come back down and test last year's low and probably like a marginal break below that. That's going to cause everyone to get bearish. They're going to be calling, a bull market top, just like they do during every one of these intermediate corrections, and they're going to be wrong again. This is we're just in the timing band for a multi-year, 4-year cycle low. I I thought that maybe it came here, but this is really early. It's not even actually 3 years into the cycle, so big question mark in my mind that maybe this was too early, and we got to have another run back down to um, test or ideally marginally break below this before we get a final 4-year cycle low. And the fact that the CRB has made a lower low below the December low uh, would strengthen the odds of that scenario playing out. That we've got a date with a move below this sometime later this fall. And so I'm I'm leaning towards that is what's going to play out. But this daily cycle is starting to get a little mature, shouldn't have more than another couple of weeks. So I'm going to say, at some point here, maybe we come down and we test the May low or maybe marginally break below it. Then I think we've got another convincing bounce, probably with some help as the next FOMC meeting is, I believe it's the 18th of September. The Fed's going to want the market in an uptrend for that FOMC meeting so they can justify only another 25 point basis cut. And then I think that sets the stage for, the final move down that could come down and at least marginally break below this December low. And then that's the point at which I think we're set up for a slingshot move back to the upside that's going to take the market to big new highs over the next 10 years. A move back down to break this it'll do a couple things. It'll generate a huge amount of fuel for a rally during the next 4-year cycle, and it will probably panic central bankers into cutting rates too much, too aggressively, and maybe even initiating more quantitative easing programs. And that will be the driver for an inflationary period. And during the initial stage of inflation, it not only, inflation not only goes into commodities, but it also goes into stocks. So right now, everybody is, only seeing deflation, and that's what always happens right before a major cycle bottoms. Everybody gets on the same side of the boat. All they can see is, the current trend continuing indefinitely into the future. So right now, everybody is seeing deflation in commodities. They're starting to see deflation in stocks. And if we get another hard move down in the stock market that breaks this, it's going to, justify in every trader's mind that they're correct, that we've got a deflationary period coming. And then that is when markets turn and catch everybody on the wrong side of the boat. And that's when the inflationary period will start. So moving on to gold. All right, so you can see in this long-term chart, gold is not showing signs of deflation. And that is, in my opinion, that is the tell that deflation is going to be temporary. It's not going to last. Smart money already sees what is coming. They're already starting to anticipate more and more aggressive rate cuts and probably quantitative easing. And so the smart money is already starting to pile into gold and silver. And that tells you that you've got to be ready for a turn, and a turn that nobody is expecting right now. And the turn is going to be towards inflation for the next several years, not deflation. So in the gold market, you can see we're starting to, well, we're breaking through this initial resistance zone here, right at about 1520-ish. We closed above that on Friday. And I think we've got, one more leg up in gold. I'm still of the opinion you need to be a bit careful here. I don't think this is the time to just be, piling on leverage. I do think we have another leg up. The problem is when you get late in an intermediate cycle like this, leverage is great if you can pick the exact top and pick it in real time. But if you don't spot the top in real time and you get caught in a hard and sudden move down, then if you're leveraged, you end up losing a whole lot of your gains before you can get out of the way, before you realize that the top has occurred and caught you with leverage. So I do think we've got another leg higher. Let me put the Fibonacci sequence here because I think that's probably where we're going. All right. I tend to think we're going to probably test this 62% retracement here, which is going to be almost 1600. And in one of my prior videos, I noted that we had what I thought looked like a T1 pattern in progress. This move from here to here was about 170 points, and then we get this sideways consolidation. Um, the pattern would call for like another 170, actually probably more like 150 to 160 points. And so the target would be somewhere right around 1600, and that 62% fib retracement is at about, I believe it's at about 1585-ish maybe. So I think that's a realistic target. Something we're probably going to shoot for here over the next 2 or 3 weeks. But I don't think you want to be heavily leveraged right now. We may come up short of that. If you have a hard target in mind of $1,590 or $1,600 and it comes up short, and then we get a really big move down on the first down day, and you get caught with that leverage, you end up losing a lot of your gains. And just the main part of the money has already been made. You don't need to be excessively greedy 16, 17, 18 weeks into a intermediate cycle. Just take what you can get in unleveraged funds here. Make sure you either get out here pretty soon, or you start tightening your stops up so that you can keep most of your gains, and then we'll get another intermediate decline here at some point. Maybe it even comes all the way back down to test this consolidation zone here, and then that's the point where you want to go heavily leveraged again. And then finally, a quick word on silver. During the final few days of an intermediate cycle, silver tends to catch up very aggressively, explosive type rallies. I'm kind of the opinion that's probably going to play out here in the next maybe couple weeks. You can see what happened right here at the top of the baby bull. Just a massive rally. It doesn't look like that much on this long-term chart, but this was a 20% gain, and it occurred over the space of only 7 days. I don't think it's completely out of the question that we could do something very similar. This rally started from like $17, went to 21. We're at $17 here. If we get that final explosive move in silver, I think we could test the baby bull high here at 21, and then I think we're going to get another hard correction into an intermediate cycle low. But that is, when you see that explosive move in silver, that's a sign that all the retail traders have finally caught on, and they're all piling in, and they're all piling into silver because it's cheaper than gold, and that is a sign that the intermediate rally is probably coming to an end when everyone, just everybody all of a sudden decides to pile into silver, and you get this really big move in a very short period of time. That's your sign to take your profits and run, because the rally is probably very near the end. And I anticipate that we're about to see something like that happen in silver here over the next 1 to 3 weeks. So, I think it's time to be on the sidelines in the stock market. We may have to come back down and retest this December low or make a marginal break below it. And metals, time to start getting conservative, and then watch silver. If we get an almost parabolic move over the next couple of weeks, that's probably the red flag waving that the metals intermediate rally in the metals has exhausted, and then it's going to be time to get on the sidelines and wait for the next correction in the metals market before you go back in heavily.